Hello, everyone. My name is Janine Donnelly. I'm the manager of webinars for Independent Banker Magazine. And on behalf of ICBA and the magazine, I'd like to welcome you to our presentation. We will be taking your questions throughout the webinar. You may submit a question by entering it into the Q&A panel at any time. If you experience technical difficulties during the webinar, please use the Q&A panel to alert us, and someone will assist you. You may download a PDF version of the slide deck by clicking on the drop-down menu labeled Event Resources. You'll find that on the left side of your screen, and you can download those right from the platform without being disconnected from the webinar. Today's webinar, Regulatory Environment, Improved Benefits, and Growing Demand for Reciprocal Deposits, is sponsored by Reich and Tang Deposit Solutions. Our featured speaker today is Tom Nelson, Executive Vice President and Chief Investment Officer. Tom is responsible for overseeing the firm's FDIC-insured programs, sales growth strategy, and product development initiatives. Tom is a frequent industry speaker throughout the bank, trust, and brokerage spaces, discussing the impact of regulatory changes in the short-term markets, bank funding, and FDIC-insured investment strategies from a growth and profitability perspective. So without further ado, Tom, I'll turn the presentation over to you.
Thank you, Janine, and thank you, everybody, for joining us today. We really appreciate you taking the time. Just to reiterate one thing that Janine said, please feel free to ask questions at any point. It's very difficult with a broad audience. Sometimes I may not go into enough detail, sometimes too much, so please feel free to ask questions if there's something that you don't understand or that I haven't properly covered. Just wanted to start by giving a brief overview of our firm, and then ultimately really what I want to talk about is regulatory environment that's changed for reciprocal deposits and more broadly how reciprocal and other extended FDIC insurance programs work. So as Janine said, our firm is Reich and Tang. We are a market leader in FDIC-insured sweep programs. We have been working in the cash management space since 1974. We started as a money fund company providing services to broker-dealers and investment managers, and have broadened out now providing services to basically all types of financial intermediaries, from banks, trust departments, broker-dealers, RIAs, and other entities. We offer banks now. We focus specifically on offering bank products at this point. Our only product now is in the cash space is the FDIC sweep programs, and we offer banks with a variety of balance sheet and liquidity management products to help them provide services to their end clients. One of the things that's unique about our firm is that we are not just bankers. We have a significant number of people in the firm that are bankers, but have a wide expertise in asset management, capital markets, and distribution. That's helped us provide products to a wide variety of customers, which is important for banks to ultimately get access to a larger group of customers than just other banks. The final point, just wanted to talk about legislative changes that we were very involved in, specifically Senate Bill 2155, probably better known to most as the Crapo Legislation, the financial reform bill that passed in May of this year, and the impact that it's had on deposits for banks. This was part of a broad regulatory relief bill, again, that I said that passed in May, had strong bipartisan support, and focused on a variety of things. What we're going to do today is try to focus specifically on the section of the bill that discusses FDIC-insured programs, reciprocal programs, and the changes that it has afforded banks that use these programs at this point. Specifically, the biggest change that occurred is that the deposits that banks take as part of a reciprocal program can now be classified as core. Up until the passage of this bill, if a bank did a reciprocal program, the deposits it took back on its balance sheet had to be classified as brokered. That was a limiting factor for many banks who chose not to use these programs, who chose to use collateralized deposits instead, because of the many issues that that many banks had with broker deposits. Under the bill, a bank is allowed to do up to 20% of its liabilities or assets, or $5 billion, whichever is less. So for many banks, this is a very significant tool that it can use to grow its deposit base. What it's done is allow banks to offer this type of a product instead of collateralized deposits to especially municipal customers in a time when banks have less collateral available, and in an ability to, they would have the ability then also, if they can free up collateral using these programs instead, to keep the collateral dry for when they need it for potentially straight home loan borrowings or other things. It also gives banks a tool to compete on a level playing field from a credit perspective, in a way that doesn't do damage to their balance sheet with large banks. Obviously, we've heard significantly about large customers who leave money at some of the largest banks in the country because they view them as bulletproof, making it more difficult for smaller community banks to compete. This is a program, a product that allows these banks to compete head-on with some of the largest banks. And most importantly, this relief bill has now allowed banks to use reciprocal deposit as a core foundational type deposit for its long-term funding strategy. So what is an FDIC-insured cash program? Very simply, what it is some type of an intermediary, whether that's a bank, a broker-dealer, a trust company, works with us on behalf of their clients, sends money into us in amounts well in excess of $250,000. We take that money then and allocate it out to the banks in our networks in increments of $250,000. What I like to say is that this is no different than what retirees around the country have been doing for years, right? You're going to multiple banks, opening up an account in increments of less than $250,000. We just do that for everybody. We do it for hundreds of banks, and unlike retirees, we do it for many, many millions of end customers. So it allows a customer the ability to work with one party and get access to hundreds of banks and have insurance levels way beyond $25 million. Now, there are three ways that banks can use we've talked about. We titled the program as a reciprocal deposit, but there are three separate ways that a bank can use these programs, either for its own balance sheet or on behalf of its customers. The first way is as send only, and what that simply means is that the bank is simply acting as a intermediary for its customers, providing a high level of FDIC insurance program for their clients that is going to most likely pay a very attractive yield to their clients, very similar to the way many banks had done repo sweeps, money fund sweeps in the past. A repo sweep is a little different because obviously the money is staying within the firm, but let's say a money fund sweep where you're just acting as a conduit for your client to satisfy a client need, maintain a client in an environment where the bank doesn't necessarily want to keep those deposits. So you just act as an intermediary, you send us your client's funds, we then send that money out to as many banks as necessary so that nothing is over $250,000 with a single bank. And it gives the banks the ability to, A, keep a client happy by keeping them within the fold, and B, generating fee income, because the bank, we pay a rate, the bank can choose to pay a rate that's lower than that and keep the difference as a fee income. For many banks, this is a preferred method of using these products because it doesn't need the money back on its balance sheet given what its loan situation is at a given time. The second way that a bank can use these programs is as receive only. And receive only is just the opposite side, a situation where a bank doesn't necessarily have customers that need to use the program, but the bank simply wants deposits. So for every send-only customer we have, we need to have a receive-only customer on the other side, a bank that's willing to take the deposits from some customer at some other bank. This is a product that banks can use to diversify their funding needs. It's a product that they can use as part of their contingency funding plan. And it's a product that they can most importantly use to grow their balance sheet without in an environment where they're not able to grow their core customer base. Now, while those are two ways of using the program, clearly reciprocal deposits are the most important. The way a reciprocal deposit program works is fairly simple. Bank would have a end client who puts money into our program. So a client has $1 million, puts money into our program, we send that money out to 4 banks. Increments of $250,000, so the deposit is fully FDIC insured. And then at the same time, we take money from other banks, other customers in the program, and send that exact amount of money back to the originating bank on a daily basis. So if a bank and their customers put $10 million into the program, we send them $10 million back. If they put 11 in, send 11 back, so forth and so on. Now, one of the beauties of a program like this is that the way we run our program, banks are not required to take back 100% of the deposits into their back on their balance sheet at any time. They can take up to 100%, and what we do is we guarantee that at any point we'll provide 100% of the deposits back to them if they wish. So what that would mean is if you look at this slide of 75% reciprocity, let's say, for instance, you as a bank have $10 million worth of customer money that you want to put into the program, you can choose to take back $7.5 million instead. This would be done in an environment where a bank has a relatively low demand, from a balance sheet perspective for deposits, but wants to maintain customer relationships. And more importantly, wants to maintain the ability to have access to those deposits at any point in the future. Oops, hit the wrong button. Apologize there. Simple chart. You can go anywhere from a 0 to 100% reciprocity in the program at any time. You don't need to think about this from the perspective of I put in $1, I have to take back $1. I apologize. I think I moved the slides around by accident. Okay. Now, it's important to note that banks can use these programs for any type of customers. If you are allowed to open up an account for a customer, you're allowed to open up an account for that customer in DDM as well. Municipalities are clearly one of the largest customer types that use these programs because of their requirement for FDIC insurance or collateralization. But these can be used for all different kinds of accounts: commercial accounts, individual accounts, nonprofits. And one of the other big areas that is starting to, these programs are starting to be used for is trust accounts. Not only trust accounts that are just opening up regular bank accounts at a bank, but also the deposits that are available from trust departments within banks, wealth management departments within banks. We have a large number of customers now that are beginning to use these programs for the sweep deposits that are out of their wealth management areas, because these are deposits that largely now are going to money funds that banks don't have access to. This is a way that a bank can offer a very high quality deposit to those customers that is going to other third-party banks, because their deposits go to a third-party bank, not back to the originating bank, but we then turn those deposits back to the originating bank. So it's a way for the CFO, the treasurer of a bank, to get access to the deposits of a customer type that ordinarily it doesn't have access to. Now, as we look at, I want to talk quickly about some of the facets of DDM. From an investment perspective, we think that there are three things that you need to look at for a customer to look at about a program: credit, liquidity, and yield. Let me step back. Somebody asked a question: are all programs deposits considered brokered or not? And they asked, wouldn't receive-only deposits be considered brokered? Yes, that is correct. All reciprocal deposits that a bank gets up to 20% of their liabilities would not be considered brokered. But if a bank takes deposits out of this program in excess of the amount that it puts into the program, or if it simply only takes money out of the program, they would consider to be continue to be considered brokered. The core definition would only be for reciprocal deposits. Thank you for that question. So as we look at the program from a credit perspective, we believe that this program is extremely attractive relative to any other options. It is a fully FDIC insured program, unlike a money fund. Our program offers insurance up to $25 million account, depending upon the underlying account type. So it would be $50 million for joint. It would be separate, for an IRA versus a regular account, just like it would for any other deposit. It's important to note, as I'm sure everybody on this call knows, there's never been a loss to a depositor of an FDIC-insured deposit. And our deposits are only placed in well-capitalized banks. The only way that a deposit could ever be placed in an adequately capitalized bank is in a situation where a bank that is well-capitalized falls to adequately capitalized and is using the program on a reciprocal basis. So one of the things under the Crapo legislation is that banks that fall from well to adequately capitalized are not forced to exit these programs. Prior to that legislation, those banks would have been forced to exit these programs, because they would be considered broker deposits. Adequately capitalized banks can't take broker deposits. And further, it's important to note that we as a firm have never had a failure in any of our programs. So from a credit perspective, we think this is all but bulletproof. From a liquidity perspective, the way this program works is that every deposit that we receive is placed into a bank's checking or savings account, an MMDA or a DDA. Nothing is put into CDs. Nothing is put into any kinds of term deposits. So every dollar is on call on a daily basis. So your clients have access to their deposits every single day. There are no limits on the number of transactions that a client can do. They can transact in our program on a daily basis. And if this is done on a same-day basis, we're able to do these transactions up until 3:15 on a daily basis. Most banks will use this program as a next-day sweep with integration, which I will run into in a moment, through their core processors. But if you want to do this on a same-day basis, we can handle transactions up to 3:15. And all monies are in the program with no risk to principal. There's no fluctuating NAV. So for banks that are talking to clients that are currently using money funds, there is none of the issues surrounding money funds in these programs. This is no different than having money simply in a bank's checking account, because that's all we're doing is just taking their money and allocating it to a checking account at a different bank. Yield, obviously an important part for any investor that uses a program. Important to note that when these programs are used on a reciprocal basis, bank can set the rate that is used in the program to whatever it wants. But when they use it as a send-only program, the rate that we pay out to clients is very attractive. Currently, it's 220 basis points. That's significantly better than the Crane Government Institutional Index, obviously much better than their retail index, much better than a lot of options that clients would have available to them. And most importantly, it's fully FDIC insured. And there is obviously a huge benefit to sell clients FDIC insurance. Now, I mentioned before integration. Our program, we are integrated with just about all of the large core processing system. You can see a list of all the deposits there. Of all the processors there. We have integration with not only core bank processors, we also have integration with core trust systems. So for banks that have trust departments, we are fully integrated so that it is seamless to those trust departments to use our product and work through all of the large trust and accounting system providers. The key to this product, we believe on a long-term basis, is that it has to be operationally efficient and operationally easy for a bank and for its end customers to use. So as we look at this program in a core banking system, the way it would work for an individual customer and the way that a bank would use this program for an individual customer is basically they would set a peg balance within the core processing system for each account and say that for an account, if balances are above some dollar amount, sweep the money out into the DDM program. If they fall below some dollar amount, sweep the money out of DDM and back into their checking account so that it doesn't impede their ability to wire money, cash checks, write checks, deposit checks, things of that nature. And on a nightly basis, through the integration we have with the core processing systems, the core processor would create a trade and pull money out of the checking account or put money into the checking account depending upon whether the balance is high or the balance is low, and then inform us of that corresponding transaction on a nightly basis. The bank would then settle with us in one net settlement, so money would not certainly be moved for each underlying customer. Money would simply be moved in an omnibus format, and in the situation where programs are used as a reciprocal program, money would not get moved at all, because at the end of the day, if you put 20 million into the program, we're putting 20 million back. If you go up $1 million or down $1 million, we owe you $1 million, you owe us $1 million, no money has to move. And the biggest thing here is that with this integration, it's seamless and it's a way for it's a way for banks to provide a attractive sweep product to its largest customers who may not be comfortable leaving deposits uninsured at their banks on a given day. I was asked a question about is there a cost to integrate this system into FIS? There are some expenses we can, that is different on a system by system basis. Those are usually fairly marginal, but I would suggest that anybody wants to look into this further, talk to their representatives at their core banking system, or certainly we'd be happy to talk to them on their behalf as well. But what we found is that the costs, do not inhibit the use of these programs. Now, I also mentioned that we're integrated with trust accounting systems. So what this means now is that for banks that have trust or any, we refer to all wealth management within a banks as trust departments. It's an overly broad statement, but that's the terminology we use. Right now, bank trust departments generally take their sweep balances, so the idle cash that is sitting within an investment management account, a trust account, and they sweep it out to a money fund, to Federated, to Fidelity, to Goldman Sachs, to whoever it might be. And the bank itself never gets any benefit of those deposits. Those are customers that the bank has worked very, very hard to get access to, and it is sending money off balance sheet to a money fund company. The integration we have with the trust companies make it simple and easy. They use this product the exact same way that they would use a money fund, except the bank now has the ability to keep those monies back on balance sheet. That is from our perspective, a game changer for banks, because the vast majority of banks never access those deposits. It's an untapped resource within bank, and it's something that we recommend banks that have wealth management departments look into and determine whether or not they get access to these deposits. I was asked a question about a list of bank and trust companies that offer our products. We will certainly respond to you that outside of here and get you that information as quickly as possible. Within the wealth management and trust space, it's important to note that banks retain the ability to set the rate at whatever they want. And one of the things I don't know if I've mentioned, but one of the key things about a reciprocal program is that banks get to set the rate wherever they want at any time. So if you want to pay your clients 2%, you can pay your clients 2%. If you want to pay them $225, fine. $150, fine. It all goes into what ultimately is your cost of funding. So as an overview, and I know I went fairly quickly through this, but I wanted the opportunity for Q&A. With the passage of financial reform in May, reciprocal deposits are now truly something that can fit into a bank's core funding strategy. They are core deposits, and they are something that banks can and most will now use as a long-term funding source for the bank. DDM is daily liquid. It offers $25 million in insurance per tax ID. We can go above $25 million, up to as much as $35 or $40 million in isolated cases, on demand. But $25 million is the number that we offer broad and wide to all of our customers. Banks have the ability to use this as a send-only, a reciprocal, or a receive-only program. It's important from that perspective because banks now can use this from, as a way to manage their balance sheet. So if they need deposits, they can be reciprocal or receive only. If they don't really need deposits, they can do send only. And importantly there, if they do send only, it's like creating a letter of credit, a line of credit, where they can turn those deposits back onto their balance sheet anytime they need to. The program can, as I indicated, can be used on a position-traded basis for large customers when an overnight program is not necessary or does not fit the client's needs. And most importantly, it can be used for trust and wealth management in addition to core banking customers, or what we refer to as brick-and-mortar banking customers. It's important to think about this as a product that can be used not only for traditional DDA and MMDA and CD customers, it's also a product that can be used throughout wealth management. So with that, Janina, I'll turn it back over to you. If anybody has any questions, I would welcome the opportunity to answer any questions that I could.
Great, Tom. We actually do have some questions just coming in now. So let's start with this one. If I send municipal deposits to a reciprocal program, should these deposits still be shown as public deposits in our wholesale funding ratio?
So as far as, I think really the critical thing there is how you're going to represent these deposits back on your call report to the FDIC. What really becomes important there is it doesn't necessarily matter the kind of deposits you send in. We will provide you with information on a quarter-end basis. We call it our call report data. We'll provide you with the information necessary as far as how you should classify the deposits that you are receiving back. So even if you put in all municipal deposits, you may take back a combination of municipal, government, corporate, other kinds of deposits, and we'll provide that information to you on a quarterly basis. So it's important to report not what you put in, but what you take out.
Okay, next one. What paperwork does our client need to sign to enter the program? So
we are very flexible. We do not have a specific agreement with your end client. Our agreement will be with a bank, and a bank will then have the flexibility on how it wants to incorporate this product into the account documentation that it provides to clients. So if a bank is offering multiple products to a bank, this might be a sleeve. If it's offering this alone, we provide what we call sample terms and conditions that banks can use as a basis, but we don't require a specific agreement to be signed between us and your end client. We don't require that you have a specific agreement that you sign with your end client. There's tremendous flexibility there. As we sign new banks up, as they enter our program, we work with them on providing information on what's most effective for them to interact with their clients.
Okay, and we actually do have a few more questions here, but before we take those, do you have on that next slide, Tom, some a spot where folks can go as we talk through these next questions if they want more info? Fabulous. And I believe that would be a live link to your website. Let's get to the next question. Are there any limits on what rates we can pay our customers?
No. Banks have the flexibility to pay. They have complete control over what they pay their clients. From our perspective, they can literally pay their client any rate they want. We have situations where banks are paying as low as a basis point, and if you can get away with that, then customers will do it. That's great. It's becoming more and more difficult as time goes on, and you can pay as high a rate as you want. Now, you do have to be careful. There are limits within Crapo that the rate that you pay falls within, your regional norm of rates. In order to not be brokered, but you have flexibility, as far as completely controlling the rate that you pay to your clients.
Here's one for you. Can we do more than 20% of our total liabilities in reciprocal deposits?
Yes, there's no limit on the amount of reciprocal deposits that a bank can do. Once they go over 20%, they will no longer be able to treat them as core. So we have situations, for instance, where we've had banks in the past that were willing to go as high as 20% in broker deposits, and most of those deposits were reciprocal. And that's how they got to the 20% limit on broker deposits, was that they were limiting their reciprocal deposits to 20%. Well, with the Crapo legislation, that number immediately went to zero. If that bank went to 40%, and we're not recommending this, we're just saying what's possible, anything over 20% of their liabilities would now be considered to be brokered. So if a bank does 25% in reciprocal deposits, 20% could be treated as core, 5% would have to be treated as brokered.
Okay, pretty clear. Next question. Are there any limits on the types of accounts that can use reciprocal deposits?
No. If you can open up a bank account for a customer type, we can open up an account on our network, and it can be done as a reciprocal deposit. So it's any account type. The only thing that we require as far as what accounts can use this is we just require, as you would have to based upon requirements, is that the full suite of KYC and Patriot Act and so forth and so on is done on your customers, which you have to do whether you use this program or not.
Okay. I'm going to go back to this one just in case, because I think you just clarified this. But so the first 20% of reciprocal liabilities, and this says get reported as reciprocal or not. Is the question, are they core or are they brokered? Or
there's some confusion around this. So historically, the FDIC required that banks report reciprocal brokered deposits. So since all reciprocal deposits were by definition brokered, the requirement was that for reciprocal deposits, there was a specific place in the call report where they would report those reciprocal brokered deposits. With the advent of the Crapo legislation, these reciprocal deposits are not reciprocal brokered deposits. They are simply reciprocal deposits. There is not a specific requirement within call data currently to list reciprocal deposits. There is only a requirement to list reciprocal brokered deposits. So the difference there would be, for instance, if a bank does more than 20% of its liabilities in reciprocal deposits, the excess of 20% would be reciprocal brokered. There are also situations where a bank could take in deposits that are brokered to begin with. And the fact that you take a brokered deposit and put it into a reciprocal program does not make it not reciprocal. So the reciprocal deposits that we're talking about they have to start as core deposits at your bank. And if you put them into a program, they remain core. But if the deposit in your bank starts as brokered, it will remain brokered. So those are the two situations where you would continue to report brokered reciprocal deposits. But up to the 20%, if you did 5% of your balance sheet and they were core customers to begin with, put them into a reciprocal program and took the money back, that money would not be listed on your call data as reciprocal deposits.
Got it. Tom, thanks for taking the time to clarify that. I think it really helped. Seeing no more questions, I want to thank everyone for attending today's webinar and let you know that we will be sending out a follow-up email with a link to the recording of today's webinar. I also want to give special thanks to Tom for sharing his expertise with us today. So that concludes our webinar. Thanks again for joining us. Have a great day.